Hey everyone, welcome back to Corporate Decoder. Today, America Great Health just filed their quarterly report, and I'm seeing some very interesting numbers that tell a real story. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a significant improvement in net income this quarter, but a closer look at the cash flow reveals a much tougher picture. America Great Health is filing its quarterly report, which gives us a snapshot of the company's financial health for the period ending the 31st of December, 2025. This report covers America Great Health and its subsidiaries, meaning we get a consolidated view of their financial performance. Let's dive into the balance sheet. As of the 31st of December 2025, the company's total assets were $193,105. This is a significant drop from $301,817 as of the 30th of June 2025. This tells us the company is shrinking its asset base. On the other side of the balance sheet, total liabilities are $4,908,221 on the 31st of December 2025, down from $6,045,644. So they have reduced their debt, which is a positive sign. But here is where things get interesting. The shareholders' deficit stands at a negative $4,715,116 at the end of 2025. This expanded from a deficit of $5,743,827 in June 2025. A growing deficit means the company owes more than it owns, and this is a red flag for financial stability. It's like owing more on your credit card than the value of your savings account. Now let's look at the income statement, which shows how much money the company made and spent. For the 3 months ending the 31st of December 2025, sales were $45,100. This is a big drop from $90,939 in the same period last year. This means they are selling much less. Their cost of goods sold was $8,564 for the quarter, which is higher than the $7,842 from last year, even though sales are down. That means it costs them more to produce what they sell, a sign of inefficiency that squeezes profits. This leads to a gross profit of $36,536 for the quarter. Last year, it was $83,097. So their profit margin on the goods they sell has almost been cut in half. Looking at operating expenses, general and administrative costs were $203,797, a slight increase from $195,155. This is a concern because when sales are falling, you would expect these costs to also decrease. As a result, they reported a loss from operations of $198,775 for this quarter. That is a much bigger loss than the $120,514 they lost in the same quarter last year. Now, here is where the numbers get a bit strange. The company reported other income of a massive $1,395,004 for the quarter. This is a huge jump from just $20 last year. This income comes from an extinguishment of debt, which means old debts were forgiven, likely due to them being too old to collect. This is a one-time boost and not from actual business operations. This extraordinary income factually pushed their net income to $1,112,684 for the quarter. This looks great on paper, but it completely masks the underlying operational struggles. With a similar period last year showing a net loss of $193,702, this big positive number comes from outside their normal business. Because of this unusual situation, basic and diluted earnings per S-share are reported as zero for the quarter. This effectively means the reported profit is so large that when you divide it by the billions of shares outstanding, it becomes a tiny fraction, effectively zero. Looking at the statement of shareholders' deficit, the bottom line shows that the net loss attributed to owners for the 6 months ended the 31st of December 2025 was $1,027,321. This is a stark contrast to the apparent net income on the income statement. This is because the gain on debt extinguishment was a one-time event and does not represent sustainable earnings. Let's turn to the cash flow statement, which is arguably the most important part of understanding a company's health. For the 6 months ended the 31st of December 2025, the company used $82,013 in cash from its operating activities. This means their core business is bleeding cash. This might seem confusing because the company reported a net income of $1,027,321. However, the adjustments to reconcile this net income to cash flow show significant non-cash items. For example, there is a $1,395,000 write-off of accounts payable, which is the gain from the debt extinguishment we discussed. This gain did not bring any actual cash into the company. Several other changes in assets and liabilities are impacting cash. For instance, inventory increased by $60,742, meaning they spent cash to build up inventory that has not yet been sold. Increases in liabilities like wage and wage tax payable of $71,465 also indicate cash being used or owed. So even with that large reported net income, the company is actually burning through cash in its day-to-day operations. This is a classic sign of a company struggling to generate genuine cash from its business activities. Under financing activities, we see an inflow of $59,471. This came from proceeds of a short-term loan and repayments to related parties. This shows that they are relying on external financing to cover their cash shortfalls. Overall, the company experienced a net decrease in cash of $21,152 for the 6 months ending the 31st of December 2025, bringing their cash balance down to $22,904. A cash balance of just $22,904 is extremely low for a company of this size and suggests they may have trouble meeting their short-term obligations. It is like having only $23 in your bank account to cover your monthly bills. Looking back at the company's history, America Great Health, formerly Crown Marketing, has undergone significant changes. There was a change of control in 2017, and the company has been involved in various ventures, including subsidiaries in California and China, and even an acquisition of an Australian medical institution that was later deconsolidated. The going concern section is always a critical read. The report explicitly states that the company has incurred recurring net losses, a shareholder's deficit, and cash used in operating activities. These factors create substantial doubt about the company's ability to continue as a going concern within the next 12 months. This is a very serious warning sign. Think of it like a doctor telling a patient they have a serious health issue and need immediate treatment to survive. This sentence highlights their reliance on the majority shareholder for survival, indicating a lack of independent financial strength. Under the summary of significant accounting policies, it is important to note how they recognize revenue. They recognize revenue when goods are shipped and control is transferred to the customer. For most sales, payment is received before shipment, which is a healthy practice. Their revenue is heavily concentrated in Asia, which can be both an opportunity and a risk. Dependence on a single region can make them vulnerable to local economic or political changes. It is noteworthy that their net accounts receivable are listed as zero. This could be a sign of very strict payment terms, or it could indicate very low sales volume. Inventories are reported at $103,909. This is down from $164,651, suggesting they are managing inventory levels, but the slight decrease in sales alongside an inventory reduction could indicate a need to clear stock. Interestingly, they recorded a one-time gain of $1,395,000 from the extinguishment of old accounts payable. This was for liabilities that were several years old and beyond the statute of limitations, meaning they were essentially uncollectible and no longer legally enforceable. It's a cleanup item rather than an operational success. The company owes a significant amount of $1,261,110 to its current majority shareholder. These are non-interest-bearing advances, meaning the shareholder is supporting the company without charging interest, which is common for companies in financial distress. Their short-term loans total $673,366. The interest rates on these loans are quite high, ranging from 10 to 24%, which adds a considerable burden to the company's finances. Their long-term loan principal is $1,323,138 with interest rates up to 20%. The company has significant principal payments due in 2026, which, given their low cash reserves, looks challenging. The company had authorized preferred stock, but it is important to note that there were no preferred shares outstanding as of the 31st of December 2025. This means this class of stock is not currently impacting ownership or financial structure. They hold 52,100,000 shares in treasury stock. These are shares the company bought back, and they are presented as a deduction from shareholders' equity. The company discusses its investment in PureCell Group TI Limited. This investment was deconsolidated in November 2025, meaning it is no longer part of their consolidated financial statements. The losses from this investment exceeded the company's investment, leading to a zero balance. This suggests a failed venture. They have operating lease obligations with leases in Alhambra and Irwindale. The total lease liability is $14,641, which is a relatively small number given the company's overall financial situation. When it comes to significant customers for the 3 months ending the 31st of December 2025, 2 major customers accounted for 18% and 11% of revenue. For the 6 months, 2 customers accounted for 24% each. This shows a reliance on a few key clients, which is a risk. On the supplier side, for the 6 months of 2025, 2 suppliers represented 57% and 39% of total purchases. This high concentration with suppliers could give them leverage over the company. Moving to the management's discussion and analysis, it reiterates many of the points from the financial statements. The company acknowledges that many statements are forward-looking and involve risks and uncertainties. This is standard legal language. This is a really important point. An auditor issuing a disclaimer of opinion means they could not gather enough evidence to form an opinion on certain aspects of the financial statements. This is a serious red flag on the reliability of their financial reporting. It is similar to a doctor saying they cannot confirm your health status because they lack critical test results. The report highlights that sales for the 6 months of 2025 were $232,659, a slight increase from $231,065 in 2024. However, the cost of goods sold more than quadrupled from $19,177 to $83,444. This is a massive increase in cost relative to sales. This directly confirms that the positive net income for the period is largely thanks to that one-time debt extinguishment gain. Without it, they would have continued to report a net loss. In the section on liquidity and capital resources, the company frankly admits that its recurring losses, shareholder deficit, and cash used in operations create substantial doubt about its ability to continue as a going concern. This is the most direct way a company can tell investors it might not survive. This statement underlines their dependence on their majority shareholders for continued survival. It signals that the company cannot sustain itself through its own operations. The worsening cash burn from operations is concerning. It shows that the core business is becoming less efficient at generating cash. As of the 31st of December 2025, the company had $22,904 in cash. This is a critical number, negative working capital, and a large shareholder deficit, combined with such low cash paints, a very precarious picture. Companies with such low cash levels might find it difficult to operate, pay suppliers, or meet payrolls. This is akin to many struggling retail companies that eventually go bankrupt when cash runs out. The management stresses the importance of estimates in their financial statements, acknowledging that actual results could differ. This is standard, but given the company's financial state, it highlights the uncertainty around their reported numbers. The report candidly admits that their disclosure controls and procedures are not effective. They point to a lack of a functioning audit committee, insufficient accounting staff with US GAAP knowledge, a lack of independent directors, and an ineffective review process. These are serious weaknesses in corporate governance, suggesting that oversight and internal checks are not robust. While management states these weaknesses did not affect financial results, the auditor's disclaimer of opinion casts doubt on this. Weak internal controls and lack of oversight can indeed lead to material misstatements, even if not immediately apparent. The company states it is not a party to any legal proceedings. This is generally a good sign, avoiding costly and distracting lawsuits. As a smaller reporting company, they are not required to detail risk factors in this specific format, but the going concern warning essentially summarizes their biggest risk: survival. The exhibits include certifications from the President, Chief Financial Officer, and Secretary attesting to the accuracy of the financial reporting. However, these certifications are made under very specific legal standards and do not negate the issues raised by the auditor or management's own admissions about controls and going concern. Now, looking at America Great Health's financial situation, it is clear the company is in a very challenging position. While the reported net income for the quarter looks positive, it is driven by a one-time gain from debt extinguishment and is not reflective of the company's underlying operational health. The cash flow statement reveals that the core business is using cash, and their cash reserves are critically low. The significant shareholder deficit and the explicit mention of substantial doubt about their ability to continue as a going concern are serious warnings. Furthermore, the auditor's disclaimer of opinion and the admission of material weaknesses in internal controls raise concerns about the reliability of their financial reporting. The reliance on majority shareholder advances and external financing indicates a lack of sustainable revenue generation. The company's direction is unclear with declining sales, rising costs, and a severe cash crunch. In essence, they are surviving on borrowed time and one-off financial maneuvers. The risk I am watching is their ability to secure enough cash to continue operations given their current liquidity and the ongoing operational losses. The lack of effective controls and the auditor's concerns means scrutiny of their financials should be especially high. What I'm actually looking for is a demonstrated ability to generate cash from operations and a clear path to profitability that does not rely on one-off items. Alright, that is our breakdown of America Great Health's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, love, comment, subscribe, and hop in the Discord community, linked in the description.